Most American homeowners over 65 are writing a check to their county every single year that they are not legally required to write. Not a small check, not a rounding error. We are talking about thousands of dollars year after year on a bill that in many cases should be zero. And the reason it keeps happening has nothing to do with the law. The law is actually on your side. The reason it keeps happening is that nobody ever handed you the form. In the next few minutes, I am going to hand you the forms. Not in complicated legal language, not buried in footnotes. I am going to walk you through exactly what they are, exactly who they are for, and exactly what to say when you call your county tomorrow morning. And I will tell you right now, before we go any further, this video is not just for struggling retirees. It is not just for low-income seniors. If your home has gone up in value in the last 5 years, which almost every home in this country has, there is a form on this list that could be worth more to you than anything else you do with your money this year. Stay with me until the end because I saved the most powerful one for last, and it is the one that almost nobody ever uses. Here's the thing that nobody in any county assessor's office will ever say out loud. Every exemption that gets filed is a reduction in the tax revenue that office collects, which means the assessor's office has zero financial incentive to tell you these programs exist. They are not going to call you. They are not going to mail you an application. They are not going to flag your account when you turn 65 and say, hey, you now qualify for 3 different programs that could cut your bill in half. That is not how this system works. The system works on inertia. Most people pay because they do not know they can stop. And the county counts on exactly that. The average property tax bill in America right now is over $5,000 a year. For a senior who lives in their home for another 15 or 20 years, that is $75,000 to $100,000 going out the door on a bill that in many cases should be dramatically lower or completely eliminated. That is not a small thing. That is a retirement account. That is a nest egg. That is the difference between staying in the home you raised your family in and having to sell it because the tax bill became impossible to afford. So here is what we are going to do. I am going to walk you through 5 forms that can change your property tax situation permanently. Then I am going to give you 3 additional moves that most financial advisors, most real estate agents, and most tax preparers never bring up. Let us start with the foundation. The first form is the homestead exemption. And I need you to hear this clearly because this is the most common and most costly mistake I see homeowners make. Most homeowners assume this form was filed automatically when they bought their house. In the majority of states, it was not. You had to file it yourself, separately, on purpose. And if nobody told you to do that, there is a real chance it was never filed at all. Here is what the homestead exemption actually does. It takes a portion of your home's assessed value completely off the table before the county ever starts calculating what you owe. In Texas, that chunk is $100,000 on the school district portion of your bill. In Florida, it is $50,000. In Illinois, it is $6,000. In Georgia, $2,000. Every state is different, but in every state, the money is real. Now, here is the part that matters even if you are fairly comfortable financially. The homestead exemption is not just about the direct savings, although those are significant. It is the foundation for every other exemption on this list. In most states, you cannot file the senior freeze, the age 65 exemption, the deferral, or the circuit breaker without the homestead already on file. It is the gateway document. Everything else runs through it. Before the action step, let me address the renters watching. You pay property tax too. It is buried in your rent. Your landlord factors that tax into every monthly payment you make. When their bill drops, your rent has less upward pressure. And if you are helping a family member who owns or considering buying yourself, everything on this list applies directly. Your one action item from this section is simple. Call your county appraisal office tomorrow. Ask one question. Is the homestead exemption currently on file for my property in my name? If the answer is anything other than yes, ask them what form you need to file to add it and what the deadline is. In most counties, that form is 1 page. You file it once, and in most states, it stays in place as long as you own and live in the home. 1 phone call, 1 piece of paper, potentially thousands of dollars every year until you sell. That was the foundation. Now here is where it starts to get interesting. The second form is one that almost no county will proactively mention when you turn 65. It is called the senior or age 65 exemption, and it sits directly on top of the homestead. It is a separate application. You have to ask for it by name. And because it is separate, an enormous number of seniors who have the homestead filed have never filed this one. What it does is add another layer of value reduction on top of what the homestead already covers. In Texas, every homeowner who turns 65 gets an additional $10,000 removed from the school district portion of their assessed value, stacked on top of the $100,000 homestead. In Florida, qualifying seniors can add another $50,000 of exemption on top of the base $50,000, for a total of $100,000 of value wiped off before the county touches a calculator. In New York, the senior exemption can cut your assessed value by up to 50%. Now here is where a lot of financially comfortable retirees check out, and that is exactly the wrong move. Many people hear the word senior exemption and assume there is an income limit that eliminates them. In some states, yes. In more than half the states that offer this exemption, no income test exists whatsoever. Texas, Florida, Georgia, Tennessee, Mississippi, Alabama, and several others grant the senior exemption based purely on age. You turn 65, you live in your home, you file the form, you get the exemption. Your income is irrelevant. Your home value is irrelevant. The only thing the county wants to know is whether you are 65 and whether this is your primary residence. So regardless of your income level, your one job is to contact your county assessor and ask specifically about the senior exemption application, what the income requirements are in your state, and when the filing deadline falls. In most states, it is sometime between January and April. Miss it by a day, and you wait another full year and write another full check to the county in the meantime. We are 2 forms in. The next one is the most powerful thing on this entire list, and it is the one I find homeowners most blindsided by when they hear it for the first time. Form number 3 is called the Senior Assessment Freeze, and the name does not do it justice. Here's what it actually does. When you qualify and file the freeze application, your county locks in your home's assessed value at the number it was when you first applied, not estimated. Locked, frozen. From that point forward, no matter what happens to your neighborhood, no matter how much the market climbs, no matter how many homes on your street sell for double what they sold for 5 years ago, your property tax bill is calculated on the number from the year you filed the freeze, not the current value, the frozen value. Let me show you what that means in real dollars. Say your home was assessed at $240,000 when you turned 65 and filed the freeze. 5 years later, based on what homes around you have sold for, the county wants to assess it at $390,000. Without the freeze, your bill just jumped by a number that reflects $150,000 of additional assessed value. With the freeze, the county still uses the $240,000 number. Your bill stays flat. The market went up. Your tax bill did not. In Texas, the freeze works slightly differently and even more powerfully. Once you turn 65 and file the application, the dollar amount of your school district property tax bill is locked at that year's total, not just the value. So if you paid $3,000 in school district taxes the year you filed, that $3,000 is your ceiling for the rest of your life, regardless of what the value does. Your home can triple. That bill stays at $3,000. Now here's the urgency, and I need you to hear this part carefully. In most states, the freeze has a filing window. Usually between January 1st and April 30th of the year, you turn 65, sometimes the following year. If you miss that window, in some states you cannot go back. You lose it permanently. Every year you go without filing is a year of tax overpayment you will never recover. And unlike some of the other exemptions on this list, the freeze does not apply retroactively in most states. It only protects you going forward from the year you file. Even if you already turned 65 1 or 2 or 3 years ago, call your county assessor today. Ask specifically about the senior tax ceiling or senior assessment freeze. Find out if you are still within the window. In many counties, you are. And if you are, file the form before you do another single thing related to your finances, because the long-term value of this one application compounds every single year for the rest of your life in that home. The next form is one the county will never bring up because it does not come from the county at all. Form number 4 is called the Property Tax Circuit Breaker. The name comes from an electrical concept. When too much current runs through a wire, a breaker trips to protect the system. In this context, when your property tax bill exceeds a certain percentage of your annual income, a state-level protection kicks in and refunds you the excess. Here is exactly how it works. You file an application, usually through the state revenue department, often as a section within your state income tax return, even if you owe no state income tax. You report what you paid in property tax that year. You report your household income. If your tax bill exceeded somewhere between 3 and 6% of your income, depending on the state writes you a check or credits your return for the difference. Massachusetts, Minnesota, Michigan, Maryland, New York, Wisconsin, Missouri, Maine, Illinois, and more than a dozen other states operate some version of this program. The refunds range from a few hundred to over $1,200 annually. And critically, the income limits that determine who qualifies are not as low as most people assume. Maryland's program covers households up to around $60,000. New York's enhanced credit applies well above that. This is not a poverty program. This is a middle-income senior protection that the state built specifically for the homeowner who is doing reasonably well, but is still getting squeezed by a property tax bill that has grown faster than their fixed income. The reason almost nobody claims it is that the state form and the county bill exist in completely separate bureaucracies, and nobody connects the dots for you. Your county sends the bill. Your state has the refund. Nobody in either office is incentivized to tell you the other one exists. If you live in a state on that list, search right now for the phrase property tax circuit breaker credit followed by your state's name. Find the form. File it. Even if it only comes to $400 or $500 a year, over 15 years, that is $6,000 to $7,000, you are leaving on the table by not knowing a single form exists. We are almost to the last form. I told you at the beginning it was the most powerful and the most overlooked. I was not exaggerating. Form number 5 is the property tax deferral. And this is the one that can literally change the financial reality of your retirement in a single filing. Here is what it does. If you are over a certain age, usually 62 or 65, depending on the state, and you meet the residency requirements, you can apply to defer your property tax payments entirely. Not reduce them, not freeze them, defer them. You stop paying. The state pays your property tax on your behalf. That unpaid balance accrues as a low-interest lien against your home, typically at somewhere between 2 and 6% simple interest, and the entire balance gets settled only when you sell the home, refinance it, or when it eventually transfers to your heirs through your estate. For the homeowner who is sitting on a home worth $400,000 with no mortgage and a Social Security check that barely covers basic expenses, this form is not just helpful. It is life-changing. You can stay in your home indefinitely without writing a single property tax check, ever. The tax does not disappear, but it moves from being a recurring drain on your monthly cash flow to a lien that gets settled from the equity your home has already accumulated. California, Oregon, Washington, Colorado, Texas, Tennessee, Idaho, and several other states offer senior deferral programs. And here is what most people get wrong about this one. They assume it is only for people who are truly broke. It is not. In several states, the deferral has no income limit at all. If you meet the age and residency requirements and you own the home outright or you are close to it, you can apply. The question to ask is not whether you qualify based on income. The question is whether deferring your tax bill is a smarter use of your equity than paying it from your cash flow every year. One critical note: if you still have a mortgage, check with your lender before filing. Some mortgage agreements contain clauses that treat unpaid property tax as a technical default. For a paid-off home, the deferral is clean. For a home with an active mortgage, you need to verify first. But for the millions of seniors who own their home free and clear and are watching their property tax bill eat into their retirement budget every single year, this is the form that nobody told you existed. Now, 3 additional moves that go beyond the standard exemptions. The first is for anyone who served in the military. The disabled veteran property tax exemption is available in virtually every state, and depending on your service-connected disability rating from the VA, it can eliminate your property tax bill entirely. A 100% disability rating in Texas, Florida, Virginia, Pennsylvania, and many others means 0 property tax for life on your primary residence. A partial rating, 30%, 50%, 70%, often translates to a proportional reduction stacked on top of everything else on this list. The application is usually a single page plus a copy of your VA disability determination letter. If you served, file this. If a parent or a spouse served, research whether the benefit can transfer. In some states it can. The second move is the surviving spouse preservation. When a senior homeowner passes away, their exemptions, their frees, and in many states, their veterans benefit do not automatically transfer to the surviving spouse. They have to be reapplied for, usually within a year of the death, usually with a minimum age requirement for the survivor, often 55 or older. Counties will not chase you down to remind you of this. If a surviving spouse does not file within the window, the tax bill can jump immediately, sometimes by thousands of dollars per year, on the exact household that just lost half its income. The form is short. The deadline is firm. If this applies to anyone in your life, act on it now. The third bonus move has nothing to do with exemptions. It is about the number your tax bill is built on. Every property tax bill starts with the county's assessed value of your home. That value is set by an assessor using comparables, square footage, and data from sales that may or may not actually reflect your property's real market condition. Assessors are wrong constantly, and every county in America has a formal protest process, usually a 30 to 60-day window after the appraisal notice arrives, where you can challenge that number at no cost. You file a one-page protest, you gather 3 comparable recent sales from your immediate neighborhood that came in lower than your assessment. You present them at an informal hearing with the appraisal review board. You do not need an attorney. You do not need an appraiser. You need 3 comparable sales and 15 minutes. In counties where this has been studied, somewhere between 40 and 60% of filed protests result in a reduction. And because your annual tax bill is calculated as a percentage of that assessed value, every dollar you knock off the assessment is a dollar that reduces your bill permanently every year going forward. Protest your assessment every single year, especially the year you turn 65 and file the freeze, because locking in a lower frozen value means that lower number is what protects you for the rest of your ownership. Here's what ties every single one of these together. None of them are automatic, not one. The county does not send a reminder. The mortgage company does not flag it. The state does not reach out when you hit eligibility. Every single program on this list sits available in a database at some government office, and the only way it gets applied to your account is if you walk in or call in or mail in the application yourself. The homeowners who are benefiting from these programs right now are not luckier than you. They are not more financially sophisticated. They did not stumble onto some obscure secret buried in a law library. They just knew the form existed, and they went and filed it. That is the entire difference between someone paying a full property tax bill they were never legally required to pay and someone who stopped paying it years ago. One piece of information, one phone call, one form. That is all that separates those two homeowners. If you know a homeowner over 65 who has never heard the words senior freeze or property tax deferral, send them this video right now. Not because you want to help the algorithm, because the next check they write to their county might be one they do not legally owe. And nobody is going to stop them from writing it except someone who cared enough to say something. One more thing. A lot of people watch a video like this, nod along, and do nothing. Life gets in the way. It feels complicated. Another tax year passes, and another check goes to the county. You do not need to do all 5 forms today. You need one call to your county assessor. One question. Is my homestead exemption on file? That conversation takes 3 minutes. If the homestead is there, ask about the senior exemption next. If it is not there, file it first. One call, one form at a time. That is genuinely all it takes to start. Pick up the phone tomorrow morning, call your county assessor's office, start with exactly one question. Is my homestead exemption on file? Everything else on this list flows from the answer to that question. And every day you wait is another day the county benefits from your silence, another day the form sits quietly at the assessor's office waiting.